Hello everyone, welcome to the yet another session on cost of capital. So guys, now we have reached session 2 where we are discussing about cost of capital. In the previous session, I have introduced the term capital and I have spoken about equity, debt. I have discussed the features of equity and debt, and I have mentioned the cost, what is involved in raising fund by equity, which we call as cost of equity, and the fund, what is required, the cost, what is required to raise the fund by debt, which we call as cost of debt, and the sum total of cost of equity and cost of debt will gives you a WACC or cost of capital. So there in cost of capital, in theory, we have discussed about significance of cost of capital. Now in this session, we'll talk about determination of cost of capital. So cost is not the amount which the company plans to pay or actually pays, rather than it is expectation of the stakeholders. So basically here, whatever the calculations we are discussing with respect to the cost of capital, we have to understand that these are not the actual data or the actual cost, what is actually involved whenever we are trying to raise fund from the market. It's all about the expectations of equity holder and debt holder. Okay, they either provide capital or they help us in the process of this working, either the broker, underwriter, or merchant banker or governments in the term of tax. So the mathematical computation of these stakeholders, the employees or the government or intermediaries is very difficult to ascertain, but more or less through mathematical understanding, we can get an idea or get to work on that part. Okay, sorry. So here, when I was talking about uh, scenarios like, for example, if a company issues, suppose 9% coupon debentures, so coupon is the rate of interest what you pay on the debt instrument. What is debentures? Already I have mentioned that part, but the expectation of investor is 10%. Okay, so then the investor will subscribe it to a discount, not at par value. So maybe the investor expectation is to get a minimum 10% from the investment, but the benefit, imagine if 100%, if that capital is raised by debt, then the benefit what is getting is only 9% of interest rate, then might not be very much interested for the investor to get into that kind of expectation. Then probably instead of raising fund, uh, maybe at the face value, normally we consider, suppose face value is 100 rupees, the investor can go with the issuing instrument a discount. Discount basically means that when the coupon is not paid, and then at the end of the day, when you do the calculation of future value is equal to present value into 1 plus rate of interest to the power time, that calculation, if you get your required cost of capital, that can be considered here. So hence the cost of capital will not be 9%, rather it would be 10%. So with the beside giving returns to the investor, in company will also have to give commissions to the like intermediaries, whoever are there, their fees, commissions have to be paid. So for intermediaries to issue debenture, it will increase the cost of capital above 10%. So on the other hand, payment of interest is a deductible expense under the Income Tax Act. Hence, it will reduce the cost of capital of the company. So here you can see or you can understand the kind of challenges what can happen when we are raising a fund from the from different sources, and flotation cost is always involved. First time whenever the issues happen, so the paying commission to the brokers, underwriters, merchant bankers, that will be involved. But if we are raising fund by debt, then interest tax deductible, that can be one advantage which can reduce the cost of capital. But flotation cost like commission, brokerages, and other things will ultimately increase it. So finding an appropriate balance or finding the best form of raising fund, either by debt or equity, in what proposition can be done, that would be challenging task for the analyzer to work on. Now, first, we'll talk about cost of debt, and first we are talking about cost of long-term debt. So, long-term debt, what is long-term debt? Already I have mentioned long-term debt have maturity more than 1 year. That's why we call them long-term debt. Like that, it include long-term loans from financial instruments, capital from issuing debentures or bonds. Okay, now the features of debentures or bonds. I have mentioned what do you mean by face value. Face value is the value what you get once the instrument get mature. That is called face value. The in whenever the debt are issued till the maturity, after every regular interval of time, interest is paid, which we called as a coupon. Okay, and then maturity period means every debt instrument have a different maturity. In the case of equity, the ordinary share don't have a maturity, but the debt instrument have a different maturity. They can be irredeemable debt, irredeemable debentures, irredeemable bonds, which means they never get mature. For them, the maturity period is not defined. It can be taken as infinite, but their occurrence is very rare. Okay, normally you'll not find perpetual bonds or irredeemable bonds in the market. Coupon or interest, basically, like what I have told already, the same thing is written here. You can read it. So, e-debentures bear a fixed interest, which we called as coupon rate, except zero coupon bond or G discount bond. In the case of zero coupon bond, zero coupon bonds are basically a work for short-term debt instrument. If their maturity is less than a year, and for them interest or coupon is not considered. They are always issued a discount. Okay, they always issue discount means their face value is always more than the price at which they are issued in the market. Okay, so for them, zero for them, interest rate or coupon is not considered. Interest or coupon is applied on the face value of the debenture to calculate the interest, and which is payable to the holder of the debenture periodically. So whenever the debentures are issued in the market with the defined coupon, then every debentures have a defined maturity, and within the defined maturity, the coupon is paid after a regular interval of time. And always, whenever you see the coupon or interest rate being mentioned, it is always given in percentage. And remember that it is always calculated on face value. So 10% debenture, 10% debenture, 15% debenture. So whatever is the face value, 15 or 10% on that. And a face value basically means like debentures or bonds are denominated with some value. These denominated values called face value of the debenture. Interest is calculated on the face value of debenture. Already I mentioned this. For example, if a company issued 9% and a non-convertible debenture of 100 rupees each. So non-convertible debenture means they cannot be converted into equity in the future. Some kind of debt instruments or debentures are convertible in nature. Convertible means sometime in the future, whenever is their vesting period or whenever there's a conversion time period, you can convert them into equity. Okay, non-convertible means you cannot convert them on equity. Normally, the debt instrument have face value of around 100 rupees, and if the company issues 9% NCD, 9% NCD means 9% is the rate of interest what they'll pay on the face value of 100 rupees. Means every time they'll pay you the interest of 9 rupees on their face value. Clear, everyone? So redemption value basically means once the instrument get mature, at what price it will bought back by the company is called redemption value. So redeemable debentures or bonds are redeemed on the specified maturity date. Based on the debt covenant, the debenture, the redemption value is determined. Redemption value may vary from face value of the debenture. So whenever we are talking about redemption value, basically means that after certain defined period, the bond or the debt instrument will be matured in the market, and with the price at which they'll get matured, that is called redemption value. It may or may not be equal to face value. Okay. And already I mentioned in the past that whenever we are raising fund by debt, we'll get the tax benefit. So the payment of interest to the debenture holder are allowed as the expense for the purpose of corporate tax determination. Okay, hence interest paid on debenture holder saves the tax liability of the company. Saving in tax liability is also known as tax shielding advantage. Already I have mentioned about tax shielding. I have discussed why interest or cost of debt is considered as a tax shielding advantage, and based on the redemption or the repayment of principal or maturity, the debt can be irredeemable. Debt means they have infinite life. They never be bought back by the company, or they can be definite redeemable debt means somewhere in the future they will be bought back by the company. So this is the formula of cost of irredeemable debenture. So the cost of irredeemable debenture is the interest into 1 minus tax, because you get the tax shielding advantage, divide by the net proceed, net proceed or the market price of the share, market price of the debenture. This is the formula of irredeemable debt instrument, where KD is the cost of debt after tax, I is the annual interest payment, NP is the net proceed or the market price. So whenever we talk about net proceed or the market price, it basically means issue price, the price at which this is issued minus the expense on issue price, and this is called as net proceed. And if the issue price is not given, then the student can assume that it is equal to the current market price, while if the issue price is not given, assume it, issue expense is not given, assume it is zero. Flotation cost basically means that whenever you are issuing new instrument in the market, they are cost what is involved with the issue, which we call as flotation cost. So the new issue of the security or the debt or equity involve some expenditure in the form of underwriting or brokerage fees, legal and administrative charges, registration, printing expenses. The sum total of all this is called as flotation cost. So see this a question that here is given 5 year ago. So 5 year ago they have given the case. So 5 year ago, Sona Limited issued 12% irredeemable debenture to rate of interest is 12% irredeemable debenture, where the price of this instrument was 103 rupees and the face value is always 100 rupees. The face value is always 100 rupees. Remember that. So if the face value is always 100 rupees, then rate of interest is 12%. So your interest would be 12 rupees. The current market price of the debenture is 94 rupees. This is the price of the debenture. Calculate the cost of debenture capital. So if you notice, they have given that the face value is 100 rupees, and the rate of interest coupon is 12%. So the interest what they'll pay is 12 rupees, and 12% on 100. And tax is given 35%. So tax is given 35%. Okay, so the interest into 1 minus tax, that would be 12 into 1 minus 35%. Okay, you'll get this. Then the price of the instrument is given as 94 rupees. So your cost of debt would be what? Cost of debt would be 12 into 1 minus 35% after reducing the tax part from this, divide by the price of this debenture. That will give you the cost of debt. So 12 into 1 minus 35% means 12 into 1.65% divided by 94. If we calculate, your cost of debt will come around 8.3%. Clear, everyone? Now going further, now let's discuss the cost of redeemable debenture. So far we have discussed the cost of irredeemable debenture. So when we have redeemable debenture, then the formula would be different. For irredeemable debenture, formula was different. For redeemable debenture, the formula would be little different. For the redeemable debenture, your cost of debt is equal to interest into 1 minus t plus uh, your redemption value minus your net proceed. Redemption value is also face value. Net proceed is also the price. And don't get confused seeing the jargon and all. Whole divided by redemption value plus net proceed by 2. Okay, this is the formula of cost of debt by using approximation method. So if I'm using approximation method, then this is the cost of debt when only interest is deductible. Okay, so here I is your the interest and NP is your net proceed from debenture. In the case of new issue of debt, current market price can be considered. RV is the redemption value, P is the tax rate, N is the remaining life of the debenture. Okay. Then here also imagine if on whole value, if I calculate the tax. So in the case of renewable debenture, where if you calculate tax on the whole value, then the same formula of cost of debt will be interest plus redemption value minus net proceed by N. This whole is tax deductible into 1 minus T whole divided by redemption value plus net proceed by 2. Okay. So remember this. Okay. So in the first case, when I was talking about, in the first case, only interest was tax deductible. In case if your in case if your pre discount or premium is also tax deductible, then this will be your formula. Okay, so now we'll do one by one questions. Like question number one, you can see a company issues. If you see the question number one, in question number one, it is given that the company has issued 10,000, 10% debenture, 10% debenture. It is a interest rate. Face value will always be 100. So your interest would be 10 rupees. Here your interest is 10 rupees, and the face value is 100 rupees. Face value is 100 rupees uh, at a premium of 10%. It has been issued on 2017 and it would mature in 2022. Means the life is 5 year. The debenture will be redeemed on maturity. The N is 5 year. And the cost of debenture assuming the tax rate of 35%. Okay, so this is the question. So you use the formula what I've given you this is redeemable debt instrument, right? So since this is a redeemable debt instrument, so the 10 rupees is your interest rate into 1 minus 35% is your tax rate plus the formula as per the formula. Uh, then your face value is 100 minus it is mentioned that it will redeem at 10% premium. So your net proceed would be 110 rupees. The life is 5 year whole divided by the face value is 100. The price is 110 whole divided by 100 plus 110 by 2. If you calculate it, you will get the cost of debenture with 35% tax rate at as 4.29%. Clear. Next question is that the company has issued 10,000, 10% debenture. Again, the interest rate is, again, your interest is 10 rupees. Again, your interest is 10 rupees. Your face value is 100 rupees. Okay, this issued in 2012 and it will mature in 2022, 10 year. The company want to know the cost of existing debt on 2017. So N is the remaining life. So after 2017, how many life is pending? 5 year. Okay, when the market price of the debenture is 80 rupees and the tax rate is 35%. Again, use the same formula. The what is the cost of redeemable debenture when the tax is calculated on interest. So you know the formula interest into 1 minus tax plus face value minus price by N whole divided by face value plus price by 2. So if you use that formula, then uh, you calculate it here, the cost of existing debenture, it is coming around 11.67%. Clear everyone? Simple calculation. Now, if I start talking about cost of debt using a present value method or yield to maturity method, so then in that case, the yield till maturity or yield to maturity, it is the present value method and it is superior method of determining the cost of debt of the company by comparing it to the approximation method, and it is also preferred in the field of finance. So the cost of maturity method is much more popular and it gives much more realistic calculation or the data to you. Based on that, we'll do a question like here the company should 10% debenture. Again, the interest rate is 10%, so the interest would be coupon would be 10, face value is 100. Uh, it is issued in 2012, matured in 2018. Life is 5 year. Company want to know the current cost of existing debt and the market price of debenture is 80 rupees. Okay, calculate the cost of existing debt at 35%. Uh, so that is the question. So here, what you can do, uh, same thing, the interest is 10, okay, and the tax rate is 35%. So you'll get the value of the interest after tax is 6.5 rupees, price is 80 rupees, face value is 100 rupees. Okay, and here if you follow yield to maturity method, if you follow this, okay, then you have to use approximation here, because understand that here in this question, understand if you're using, you cannot use shortcut method. The formula which I told you, interest into 1 minus t plus face value minus price by n whole to the power face value by plus by 2. This is based on approximation. This is not based on the real data. Okay, so for doing the real data, what you have to do, consider the 5 year, 1, 2, 3, 4, 5. So consider the 5 year. In this 5 year, what you are getting? So the future cash flow, what you are getting, the future cash flow is that interest into 1 minus tax. So after deducting tax every year, the 10 rupees into 1 minus 35%. So you are getting as 6.5 rupees that you are getting every year till 5 year, that you are getting every year till 5 year. Then on 5 year, you will get the face value of the instrument. Face value is 100 rupees. Sorry for disturbance, guys. Some construction work is going around. So the So once we have determined the cash inflows for us, these cash flows are happening in the form of coupon and face value. Now the discounting rate WACC is not given. By using these approximation formulas and all, we have calculated the WACC. I think the same question when you use the WACC here, the same question when you use the WACC here, the previous question. Okay, the same data was there, no? 5 year life. Life was 5 year. Life was 5 year. Okay, you got around 11 to 12%. So you know that your answer is between 11 to 12%. So what you can do here, just assume a discounting rate as 10%. Okay, just assume the discounting rate as 12%. Assume the discounting rate as 10%. Since you know the answer is near about 12%. So what you can do, find the present value, take discounting rate as 10%. Okay, and then find the present value of this cash flow. So means 6.5 divide by 1 plus 10% or 1.1 for year one. then 6.5 divide by 1.1 for year 2. Like this, you can do for 5 year. 6.5 divide by 1.1 to the power 5, then plus uh, face value is 100 divide by 1.1 to the power 5. This you do for 5 years. Okay, and then do the total sum of this. So this will give you the value, uh, the price that should be equal to the price. Your price is how much? Your price is given as 80 rupees. So that should be equal to your price. Your price is 80 rupees. So you can do this calculation. 6.5 divide by 1.1 plus 6.5 divide by 1.1 square, till this do till 6.5 divide by 1.1 to the power 5 plus 100 divide by 1.1 to the power 5. Do this. Okay, do this. So if you can do for 10%, you are getting as 86.73225. And then since you know the answer is near to 12%, if you consider discount rate at 15%, you'll get 71.50668. So once you get these two values, one value higher than 80, the required value what you're looking for is 80. Now 80 is the price, and the value higher than at 10% is 86.73225, and 50% is 71.50668. Then you can apply the formula that your required interest rate, this is the interpolation formula, is equal to lower interest rate, which is 10%, plus higher interest rate 15% minus 10% into value at lower interest rate. Value at lower interest rate is 86.73225, 86.73225 minus required value. Required value is 80 divided by value at lower interest rate 86.73225 minus the value at lower interest rate. That is uh, what is that value? So this value is 71.50668, 71 point, do whatever the value is there, 71.50668. If you do this calculation, this is value at lower interest rate, value at lower interest rate minus required value, divide by value at lower interest rate minus value at higher interest rate. So if you just calculate it, you are getting your answer near to 12%, which is 12.21%. Okay. So remember this. So this thing, so when you in the price is equal to your coupon by 1 plus yield till maturity for year 1 plus coupon. The coupon is constant, plus 1 plus yield till maturity for year 2, like this till the end of the life of the debt instrument. Coupon divided by 1 plus yield till maturity to the power n, plus the face value, plus the face value of the debt instrument, whole divided by 1 plus yield till maturity to the power n. Or you can use the formula. This you can consider as the present value of annuity. So this is equal to coupon divided by yield till maturity into 1 plus yield till maturity to the power n minus 1, whole divided by 1 plus yield till maturity to the power n, plus face value divided by 1 plus yield till maturity to the power n. So this is the formula you can use when you are using yield till maturity formula. You can use this formula. This will help your calculation. This will simplify your calculation. If you're using this formula, the calculation will be much more simplified and become easy. Here, everyone, remember this formula. So this will help you to solve the question. So if you're using this cost of debt by using yield to maturity approach, this approach will be much more easier and you'll get the answer very easily. When you have zero coupon bonds, like what you can see in the next example. Okay, so the face value is given as 1 lakh rupees and the price is 2,500 rupees and the it get mature after 25 years. You simply use the compound interest formula. Future value is equal to present value into 1 plus the rate of interest to the power time. Future value is 1 lakh. 1 lakh. What you will get means future. That is the face value. What you are paying is 2,500 1 plus a rate of interest, which is your cost of debt to the power 25. So if you bring it here, 0 0 get cancelled, and 25 by 100, 25 fours is 100. This is 40. 40 to the power 1 by 25 minus 1 into 100. That will give you your cost of debt. Clear everyone? So 40 here, 40 to the power 1 by 25. This minus 1 into 100, if we'll do, we'll get 15.899%. Clear everyone? They are giving here somewhere around 15%. Clear everyone? So this much we'll do in the present class. Amortization of bond will from there we'll start the next session. Thank you everyone.